let me kind of give you a quick sense of what our half-year results look like and more importantly, what we're seeing in the markets at the moment and the outlook for this year and how that positions us going forward. But as Mark said, we feel very, very good about the half-year result. We delivered top-line growth of 8%, bottom-line growth of 10%. 75% of our business is pallets, and that contributed very, very strong performance. We had growth in that business of about 7%, but more importantly, very strong leverage down at the bottom line across all of the businesses that we saw globally. And I'll just give you a flavour of what the composition looks like, because I think there's obviously a lot of commentary around what's happening economically in some of the key markets, and I'll give you a sense of what we're seeing. So maybe starting with the US. In our pallets business in the US, we actually had quite moderate organic growth, but very, very strong net new business wins. So we're able to continue to win market share and convert customers to our pooled solution, but organic growth was a little over 1%, and that's fairly consistent with what we're seeing from some of our customers, like beverage in particular. Western Europe was a touch better organically, which might surprise a few people. It was actually closer to 2.5% across Europe. Net new business wins for us were a little bit more moderate, but the organic obviously surprised on the upside. And then here in Australia, organic for us was quite strong, in excess of 3.5%, which once again might surprise people if you read the front page of the Fin Review every day. But to some degree, we get some leverage there because of our exposure to Aldi, and Aldi's growing quite quickly. So pallets extremely strong. Our RPC business was a little bit mixed. It's dominated by the European reusable plastic crate sector. That grew very strongly. We continue to win new retailers in Europe, and we delivered the highest return on capital since we acquired that business back in 2011. So very happy with how Europe's going. The North American RPC business was a little bit more challenged. Continues to grow quite strongly on an underlying basis, but we did lose some volumes to one of the major retailers called Safeway. They were the fourth largest retailer. We lost about 2/3 of their volumes. They were acquired last year by Albertsons, which is owned by Cerberus. Albertsons are now running the Safeway retail network, and they've chosen to go back to cardboard. So we haven't given up on that. We're working with them. But excluding Safeway, we grew in the US by 17%. So we're still very happy with underlying penetration. And then in the containers business, I'd say top line was generally okay except for the Ferguson business, where on a like-for-like basis it was down 32%. And bottom line was the area that disappointed, partly because of Ferguson and partly because of some operational costs. But 75% of the business performed extremely strongly. And off the back of that, as Mark said, we did upgrade guidance. So rather than top line and underlying profit growth of 6 to 8%, we're now guiding to 8 to 10%. So we've increased that 2 percentage points at the bottom and the top end of the range. And that translates to underlying profit guidance for the full year of between $1 billion and $15 million to $1 billion and $35 million at the top end. So that's about a $15 million increase on where we were. Off the back of the strong result in the first half, we also increased dividend from 14 cents for the interim and final dividend last year to 14.5 cents. So it's about a 4% increase. We did leave on the dividend reinvestment plan, but this will be the last time the DRP is in place, and we'll neutralise that going forward.